Welcome to This Explainer. Today, we're diving into a really fascinating contradiction. You see, when we talk about building wealth, we usually treat it like it's just one big, uniform skill. But honestly, it's not. The hard math of investing and the actual psychology of financial survival are really two totally different halves of the exact same coin. Getting money takes one set of behaviors, sure, but keeping it, that requires a completely different mindset. And mastering both is really the only true way to hit that lasting financial freedom.
Section 1. A Tale of Two Investors. So, to really wrap our heads around this wealth dichotomy, let's travel back to the roaring 20s. We're going to look at two incredibly successful guys who operated in the exact same economic climate, yet met totally different and, frankly, tragic fates. Picture this, the infamous stock market crash of October 1929. During one utterly devastating week, days we now know as Black Thursday, Black Monday, and Black Tuesday, over a third of the market's value literally just vanished into thin air. It brought total, unfathomable ruin to so many people. One of those guys was Abraham Jermansky, a massively successful real estate developer. Like a lot of folks back then, he bet heavily on stocks. When the crash hit, he was last seen wandering Wall Street, tearing a strip of ticker tape to shreds in absolute despair. But flip that coin over. For master trader Jesse Livermore, that exact same crash was, well, the greatest week of his life. Livermore had brilliantly shorted the market, essentially betting that stocks were going to tank. When he walked through his front door to a terrified family who thought they'd lost everything, he had to break the news that he just scored the inflation-adjusted equivalent of a $3 billion payday. In a single afternoon, he became one of the richest men on the planet. But here's the crazy twist. Even with that massive, mind-boggling win in 29, Livermore got overconfident. He started making larger and riskier bets. And just 4 years later, he lost every single penny to debt and bad trades. You see, both Jermansky and Livermore shared the exact same fatal flaw. They were brilliant at getting wealthy, but absolutely terrible at staying wealthy. Getting money, that's about taking risks, being optimistic, putting yourself out there. But staying wealthy, that means embracing frugality, humility, and honestly, a healthy dose of paranoia.
Section 2. The Formula for Wealth.
Now, before we master the psychology of keeping money, we gotta understand the objective mechanics of how it's built from the ground up. The US government's official investor portal lays out the absolute basics, and it's pretty straightforward. Step 1, you have to control high-interest credit card debt. I mean, no investment return is ever gonna outpace the brutal math of 20% interest. It's an absolute wealth destroyer. Step 2, build an emergency fund. You need that cash buffer so you aren't forced into bad debt when life inevitably throws you a curveball. And step 3, invest a portion of your paycheck into tax-advantaged accounts like a 401k or an IRA. That's the mechanical groundwork right there.
And that brings us to the ultimate wealth formula. Regular investments plus time equals wealth. You really don't need some massive lump sum to get started. You just need to consistently plant those little financial seeds, and this is the crucial part, give them the time they actually need to grow into a massive tree.
That kind of organic growth happens through the magic of compound interest. It's not just earning interest on your initial deposit. It's earning interest on your initial money, and then, here's the real secret, earning interest on that interest. So say you have $100 and you earn 5%. Now you have 105. Next year, you aren't just earning 5% on the 100, you're earning it on the 105. Over decades, this snowballs into something absolutely extraordinary.
Section 3. The Rule of 72. All this growth leads us to one of the most powerful and honestly kind of fun mental shortcuts in all of finance. If you've ever looked at an investment and thought, okay, but how many years is it actually going to take for my money to double? You are definitely not alone. And instead of firing up some crazy spreadsheet, there's a remarkably simple math trick for this that actually dates back to an Italian mathematician in the 1400s.
Here's how it works. You simply take the number 72 and divide it by your expected annual interest rate. That gives you the approximate number of years it'll take to double your money. So expecting a 6% return, divide 72 by 6, and boom, it takes 12 years to double. Got a 9% return, 72 divided by 9 means you double your wealth in just 8 years. It's such an empowering little tool for quick mental math.
Now, you might be thinking, why the number 72? Well, for the math nerds out there, 69.3 is technically more accurate if we're talking about pure continuous compounding. But 72? It's the perfect everyday tool because it divides so cleanly by almost all the common interest rates, 2, 3, 4, 6, 8, 9, and 12. It basically lets you project your financial future on the back of a napkin. Section 4. The Survival Mindset. But here is the stark reality.
All that math, all those compound interest formulas, they are completely useless if you can't survive the market's darkest days. When we think of massive wealth, we naturally think of Warren Buffett, right? We obsess over his stock picks, his business evaluations. But his real secret is actually what he didn't do. He survived 14 recessions without panic selling. He never got swept up in excessive debt. He didn't burn out, and he didn't risk his reputation. He just survived. He stayed in the game from age 10 all the way into his 90s, and just like compound interest do the heavy lifting. To show you just how crucial this is, let's compare Buffett to his former investing partner, Rick Guerin. Guerin was brilliant, just as smart as Buffett and Charlie Munger. But during the brutal 1970s crash, Guerin was heavily leveraged. He'd used borrowed money, margin loans, to invest. So when the market tanked 70%, he got a margin call and was forced to sell his stock to Warren at under $40 a share. It perfectly illustrates author Nassim Taleb's point. Having a strategic edge means absolutely zero if you don't avoid total ruin. And this is exactly why building in a margin of safety is so critical. Maybe that's a frugal budget, a hefty cash buffer, or a really flexible timeline. But the core philosophy here is that the single most important part of every financial plan is planning on your plan, not going according to plan. The real world is just messy. Your plan is only useful if it leaves enough room for error so you can survive the unpredictable stuff, like pandemics, job losses, or out-of-nowhere market crashes. To actually pull this off, you need what we might call a barbelled personality. On one end of the barbell, you need sensible optimism, this fierce, unwavering belief that the long-term trajectory of the economy and human innovation is up and to the right. But on the exact opposite end, you need short-term paranoia. You've got to be deeply aware that the road to that prosperous future is literally filled with economic landmines that could wipe you out if you aren't paying attention. Which brings us to a massive global perspective on why this specific mindset is an absolute must-have. When you look at the world economy, it is essentially a story of continuous destruction in the face of incredible, relentless progress. Just look at the data from the last 170 years in the US alone. We lost 1.3 million Americans in 9 major wars. We suffered through 33 recessions spanning 48 cumulative years. The stock market dropped by more than 10% over 100 different times. But despite all that constant, terrifying chaos, our overall standard of living still increased 20-fold. Think about that. Growth amid loss. You need the paranoia to survive those recessions, but you need the optimism to hold on for that 20-fold growth. So, as we wrap up this explainer, here is the ultimate takeaway. Getting wealthy is all about taking risks, sure, but staying wealthy, that is entirely about surviving them. Don't just chase the highest possible return at the expense of your own safety. I want you to ask yourself this right now. Are you building a financial system in your own life that is totally unbreakable? A system that ensures you'll actually be around long enough to let compound interest work its absolute magic? Something to think about.